So good morning and welcome to the Retired Living Truth Series. And today's topic is the truth about paying for retired living. And I'm being waved and I need to stand in front of the camera. So, has anyone noticed the cost of things is becoming more expensive? I think everyone has, haven't they? Yeah, it's pretty kind of obvious. What are some of the things that have become more expensive that have affected people?
Everything.
Food. What else? Gas. Yeah, two obvious ones. Food, gas. What else?
Taxes are up.
Taxes are up. I didn't realise that. Taxes. What else? Beef. I heard bacon is going up astronomically. I don't eat bacon, but someone was telling me how much bacon is going up. What else? Beer. Wine is going up. Well, that one impacts me. It's not like wine.
Temper.
Whiskey, yeah. So everything pretty much in our life. What has gone down?
Nothing.
Dead silence. I can hear a pin. It is Social Security. We're going to talk about that. Has Social Security gone down? Yes, no, maybe? Amen. Yeah, so we'll talk about that. Medicare has gone down? Well, Medicare's going up. Okay, so some confusion. Hopefully we can clarify. So, as most of you probably know, inflation has really jumped up in the last several months. What's inflation at the moment? If we went back 6 months, it was around between 2 and 3%. What is it now?
9.
Yeah, up around 9, 8.5%, 9%. Yeah, so that's a huge jump that obviously impacts all of us. And did anyone get the most recent copy of the AARP magazine? So June, July, August. Yeah, what was the big main topic on the front page?
Join.
Anyone remember? I'm asking because I've forgotten what the actual title was. It was talking about how to beat inflation. Now I remember, yeah. 99 tips to beat inflation. So who's implemented, those who put up their hand, who have implemented all 99 tips? Leo, he's on number 99. Yeah, so there were 99 tips on how to make our money go further. That's probably something most of us need to be looking at for such high inflation. So today's topic is all about how do we pay for retirement living, and more specifically, more as it relates to housing. So we're going to talk about it generally, but our houses get more expensive. As we've talked about before, our houses need maintenance. We've got an investment property that needs a new roof. I just about fell over when I found out how much they wanted to put on a new roof. And what a roof cost 10 years ago to what it is today. It's like, oh, wow, that's a lot of money for a roof. So yeah, houses are becoming more expensive to maintain. Moving is becoming more expensive. So we're going to talk about how do we pay for that. And are we living longer or shorter? Yeah, so it's a great reward that we all get to live longer. And what is the downside of that?
No money.
Money, yeah, money has to last longer. So we're going to talk about that as well. So one little thing I would just like to point out and have grace for everybody is that we're all in different financial positions. So there's people who are doing really well, and then there's people who, life's a lot tougher. So just keep in mind, and as you ask questions and make comments, just remember everyone's in a different position, everyone's taking a different life journey to where they are now. But we're all in a position where we can be proactive and create the best life for us moving forward, no matter what our situation is, if we do what? Planning. We always talk about planning, having a plan. So those who don't plan are doomed to what?
Suffer.
Yeah, maybe not failure, yeah, maybe mediocrity or maybe less than where they could be. And those who plan, typically from experience, and certainly stuff does happen, but those who plan typically end up as a whole better off than those who don't plan. I'm sure we can all agree with that. So we're going to talk today a little bit about some proactive planning that we can do. Did everyone get a handout? Of course you did, go on the table. Does everyone have a binder? Yep, we've all got binders. Fantastic. And what else do I have for housekeeping? For anyone new, the way this will work is I'm going to ask a series of questions on your behalf of our panellists who will join me in a moment. And then at 11 o'clock we'll open up to your questions of the panellists, and then we'll be out of here by 11:30. So where's my clicker? Oh yeah, I just wanted to thank our helpers this morning. Some greeters at the door, our education partners. I think I saw Vic greeting people as they were coming in. I think I saw Matt from Centerwell Health. And who else was helping? I saw on coffee, I saw...
Brian.
Who was on coffee?
Jennifer and Gary.
Thank you. Oh, Gary and Jennifer, yeah, from UNR, Centre for Aging. That's Annette yelling out. And then there were some people greeting at the door. I know Stacey was helping people coming in, and Stacey's going to help make sure our temperature stays cool today. Someone snuck up, and I was wondering last month why it was, I think it was last month, why it was like 75 in here. Someone had snuck up and really upped the temperature, and I was like, so we're going to, so just on that, if you are cold in the room when you come, I just suggest bringing along a sweater in the future. And I see some people have brought sweaters. It just gets really hot up here under the lights for us and the panelists, and with so many people in the room, it also gets very warm in here. So thank you to our education partners that make this all happen. We appreciate you, and I'd appreciate a clicker that worked. Ryan, could you come up and just hit the space bar so I can see what the next slide is?
Like the whole time?
Yeah.
I'm supposed to be up there.
Yeah, you can do both. Yeah, so let's talk about some myths and truths.
Brett, telephone?
I've already talked about telephones, yeah. If you were present in the room, that's my wife, Annette. Everybody wave to Annette.
Glad to see you again.
Annette obviously wasn't in the room paying attention like the rest of us. She was out there helping people calm themselves. But thank you, Annette, for that reminder. So is this a myth or truth? Most people are completely prepared. They have planned where they will live and how they will fund their long-term care as they age. Is that a myth or a truth?
Myth.
That's a myth. Ryan, can you... So our truth, more people spend more time discussing acceptable dinner plans than planning for how they will find adequate living arrangements as we get older.
True.
Is that true? Yeah. And why is that true? Because it's way more fun to plan dinner and vacations and dealing with the more challenging things. Let's have a look at the next
That's what
one.
we talk about when we go out to dinner.
Go. Healthy people won't need long-term care. A myth or truth? That's a myth. And our truth. So according to Genworth, and we'll talk about Genworth a little bit later, Ryan will, 7 out of 10 people will require long-term care at some point in their lifetime. Yeah, so some of us have that belief that, yeah, I'll never need it. The odds aren't in our favour. At some point, most of us are going to need some form of long-term care. Does anyone recognise the name Genworth? What do they do?
Long-term
Long-term
Yeah,
care.
long-term care insurance. So their numbers are probably pretty accurate, because what do they not want to do, being an insurance company? Pay,
insurance.
yeah. So hence why we'll talk about premiums and so forth going up, because they know how many people are going to need long-term care. And we're all living, what? Longer, yeah. Is that a good thing an insurance company wants to know that everyone's living longer?
No.
No, because it means they're probably going to have to do what? Pay out more, yeah. Yeah, so it's to their advantage that we don't live long lives, because then they get to keep the money. The longer we live. Thank you, Ryan. One more. Perfect. So I'd like to invite our panelists to come up and join us and help us answer some of the hard questions. So Ryan, Brian, and Tom, can you come up and join me? I guess I'm going to be the clinical person.
I can do it.
Oh, thank you. Oh, actually, now it's working.
I'll just hang out a piece of it.
Okay, thank you. So let's start with you, Ryan, once you get your mic on. You guys could all just turn on your microphones. So Ryan, can you tell us who you are, what organisation you're with, and why you would be on the panel for today's topic?
Yes, so my name is Ryan Hart. I'm the owner of Amada Senior Care. We are a non-medical in-home care agency. We provide care at home, just hence the name. So we provide caregivers between 8 and 24 hours a day, sometimes 7 days a week, minimum is 3 days a week. And they come to your home and they'll provide assistance with activities of daily living, which include, meal prep, transportation. We can go shopping for you, anything like that. And then also activities of daily living, which are things like transferring, ambulating, helping folks go to the bathroom, which, a lot of you guys aren't there yet, but maybe you have friends or family that are there. So we always like to just get our name out there and talk to people about what we do and how we do it. And then more importantly, today we're going to really focus on long-term care insurance. We're experts in long-term care insurance. We don't sell insurance, I want to make that very clear. But we help people as it relates to providing, getting care providers that long-term care insurance will pay for.
Great, thank you, Ryan. Brian.
Good morning, Brian Loy, Sage Financial Advisors. We help people make smart financial decisions. And I once wanted to be a doctor when I was in college, but my junior year I realized I didn't want to be around sick people. And I leapt into this other career where I can impart something on a parallel path, which is financial wellness. And it's a great job. My job's all about solving puzzles. And just kind of like Ryan here is talking about, is helping people navigate the future.
Great, thank you, Brian. Welcome. Tom, same question to you.
I'm Tom McDonald with Mutual of Omaha Reverse Mortgage. I've been a reverse mortgage specialist for about 20 years now. That's all I do. I bought my home here with a reverse mortgage. And I did that partly so that when I'm in my 120s and need in-home care or some other needs at that age, I'll have something to go with the line of credit choice.
Thank you, Tom. So let's start with the first question with you, Brian. So if we look at our financial situation, all of us, what should we be doing now that maybe we aren't doing, or if we haven't done it, we should be doing? And what should we be knowing about the market that's kind of in turmoil at the moment in terms of inflation?
Lots of questions there. I once was as tall as Brett here, but a few market corrections have shortened me up. I mean, think about that. We're all trained to expect bad weather. We're going to go over the hill and run into a snowstorm and have to chain up. We're going to be put on hold, maybe. And 100% of the probability, we're going to have a recession. But yet, whenever it happens, people are all surprised. Right? Right? Like, what happened? So part of this is about trying to plot the future and being able, you talk about having a plan. Most people have a plan, but those plans can change. Or as we age, I know that I need some help just kind of deciphering ideas. So it's about navigating the future. So some of the things to do are make sure you have a plan, periodically review that plan, and to have a team of allies around you, whether it's professionals, family, even your social and spiritual circles to help you think things through.
Thank you. Should we be revisiting our budgets? Should we have a budget?
Budget's a four-letter word, right? In 1976, my mother took us to Hawaii, and there was a book called Hawaii on $25 a day. I don't know what 25 bucks a day is going to last today. Maybe it's more $2.50, but being good Chinese, we were told to take baggies to buffet lines. People describe to me money as kind of like silly putty. How do you make it stretch and last? Because of either you talk about longevity, getting longer, or inflation, making things more expensive. So what can you can only do two things with money. You either spend it or you save it. And inflation affects all of us. It makes things more expensive. It affects the investment returns. So things that you can do, maybe, are increase your income. What can you do to increase income? Either work longer, maybe defer Social Security so you can get higher benefits, maybe increase your investment returns. Second thing is to reduce expenses to the extent you can. Shop your insurance. If you have variable rate debt, what can you do to cut that cost down? You guys that are on Medicare, some of those premiums go up because of your income. Has anybody seen that happen? You can petition the IRS. It's a form. It's called SSA-44. If you have a change in income, you can ask them to reduce your income. And then business owners, we all have higher, less margins. So what can we do to make our money last longer?
Thank you, Brian. And just on that, when we were talking, you were talking about, we plan to live to 80 or 90 or whatever the number is. Tom's talking 120. I'm hoping 125 to make it down. But should we be revisiting what our plan is? Maybe we've done a plan thinking we're going to live to whatever age, but we're probably going to live longer than we think. Should we be looking at, will my money go far enough? Do I need to change my habits to or my investments or my sources of income in order to, knowing we're going to probably live longer?
Yeah, how many of you guys have taken a long distance road trip? Right? And we all watch that gas meter. Am I going to have enough gas to get where I'm going? And not to withstand that gas has gone up 43% in the last 12 months. But how much gas we have and longevity, we don't know how those last years of life are going to be. Right? I think that most people, what we all want to do is live life, have our freedom and choices, to be able to do what we want when we want. We want to live life with security, not worry about where our next meal's going to come or living underneath the bridge with the trolls. But we just don't know how long it's going to be, and Ryan's going to talk about this, about the assistance for long-term care. I think the average medical cost, I think, for people is one of your most expensive things in retirement living. So absolutely adjust it. Plus there's options that you have, whether it be on long-term living and people downsize, we're talking about real estate, or you can talk about how to use your equity in your home to stay where you're at, or maybe where you're going to end up living.
Great, thank you. And actually, we've had a couple of people come and ask us, you were talking about increasing income. Could I rent out a room and have someone for company in my house, and that also be additional income? I know some people are going, hell no, I'm not sharing my house with anybody. But that's another way to increase income if you have a spare room and wanting company. Another way to have money coming in. I don't know what the implications are as far as Social Security and having that income, but we could ask. So let me jump to you, Tom, because Annette and I, we have, for those who don't know, Annette and I are both in real estate, and we have clients coming wanting to sell a house to be able to maybe move to something more manageable or in one of the wonderful retirement communities that we have in the area. And that's because all their money's tied up in the house and they're trying to free up some equity. What else could we do before we sell our house, Tom, to stay there longer, to make use of the equity that's already in the house?
When I talk to people and what the possibility is maybe selling the house and moving or staying in the house, I ask them, if money isn't an issue, what is it you want to do? And that's what you should aim for. So if you want to stay in the house, then perhaps the reverse mortgage is a good choice. With the reverse mortgage, you can take funds out in 3 different ways, either cash up front, and for the most part, we use that when someone has a mortgage. It has to go away. And when the mortgage goes away, their cash flow usually improves enough that they don't need the other funds in the reverse mortgage. But they can take it a second way as monthly payments to themselves, so they get money on a regular basis. Sometimes someone doesn't have an existing mortgage, and just an extra couple $100s a month puts them over the top so that life's easy. The third is the line of credit. Any funds that aren't used for the first 2 options are there for the line of credit. And the line of credit grows over time. So being able to have the reverse mortgage and have some of that flexibility is very important for somebody who wants to stay in their home. Again, if they want to move, then they might sell the house. And their choices might be some of the different retired living places we've seen. Myself, I moved into Adele Webb because I like the idea of active living with a lot of different groups and things going on, others my same age. And I was able to buy that house for less than what I sold my condo in Napa. I put a down payment on the house, which is more than a regular mortgage. It was closer to 50% at the time. It might even be a little bit more with higher interest rates. And the rest of the funds I was able to put into my investment accounts. And you know what's happened over the last 4 years since I bought the house, I'm way ahead of the game. That's not guaranteed, obviously.
So you're able to buy your current home using the reverse mortgage and freeing up money to invest?
To invest or to live on it. Maybe that extra cash that you have, in the old days you could put it in the CD at 6% and live on that, but maybe you find something else that provides the cash flow that makes it advantageous for you.
And so I can take that in 2 ways. I can take it as a lump sum, am I understanding that correctly, to invest or put in my bank account?
You're talking about the funds from the reverse?
Yes.
Yeah, 3 ways. Lump sum, typically we use that to pay off an existing mortgage, maybe pay off your car loan or something. Money on a monthly basis that comes automatically to you, and then the line of credit.
Fantastic. And then, are there any downsides to the reverse mortgage? What should we be aware of before we go down that path in terms of having a plan?
There's probably 2. The first one that everyone sees when we sit down and look at the numbers are the different fees. And they are extensive, but they all do something. The first is MIP, that stands for Mortgage Insurance Premium. That goes to the FHA, so that the FHA insures the loan. That does 2 things. One, if the loan amount is more than the value of the house when it comes due, when you sell, move, or pass away, neither you nor your heirs have to make up the shortage. The FHA fund will do that. It's insurance. Everybody pays into it. When something doesn't quite go according to plan, the insurance fund pays out. That happened a lot in the 2008 downturn. So the FHA actually exhausted that fund.
What does that acronym stand for, Tom?
MIP, Mortgage Insurance
No, no,
Premium.
okay.
Oh, Federal Housing Administration. They're a division of HUD, Housing and Urban Development.
Which is part of what, private company or?
HUD is a government agency that's actually a cabinet position for the Secretary of HUD.
Thank you.
Lost track.
Second down, please.
Down thing. So the MIP is 2% of the home value. So if the home value is $600,000, which is the average price of a home in Reno nowadays, that's $12,000 right there. Then there's an origination fee that does go to the lender for any home values in Reno that's capped at $6,000. And then third-party fees, like when you're buying a house, title, escrow, appraisal, county recorder, notary, all those things where some third party is doing something and they're going to get paid for what they do. And that's in the neighborhood of about $3,000. So that's a lot of money, and that turns a lot of people off.
So what was that in total on the $600,000 house?
Well, 21,000, give or take.
So 21,000.
Most of that comes out of the loan itself. Your upfront costs are going to be counseling and the appraisal. The way it's done frequently, that's in the neighborhood of $500 out of pocket, give or take.
So I'm giving that up though to be able to access all that equity that I otherwise have no access to.
Exactly. Imagine investing $21,000 in the stock market. Could you expect to have a few $100,000? First of all, right away, because that might be what your line of credit is, and then the growth of the line of credit at the same interest rate we're charging you, that's a lot of money 20, 30 years down the road. I bought my house with a reverse mortgage. I paid those fees. I probably know more than most people about a reverse mortgage, and I felt it was worthwhile.
So you said there's an interest rate of being charged to have access to this money. So
Correct.
what are my monthly payments again? How much am I paying each month?
Zero.
Zero. Okay. And how long am I paying zero?
As long as you live in the house.
Yeah.
The loan doesn't come due until you sell, move, or pass away.
So what are some of the myths that we hear, like, oh, people are losing their houses because they did a reverse mortgage? What's that about?
Rumors, apparently. I've never quite figured out where that started, but a lot of people say, Mabel, don't do the reverse mortgage, they'll take your house. Not correct. First of all, it's just a mortgage. People don't seem to understand that. They think they're giving up the house for currently, say, 40% of the equity. It's just not that way. It's a loan. You pay it back when you, for instance, if you sell the house, the escrow officer is going to write a check to the mortgage company, just like they would any other mortgage company, and give you a check for what's left over.
So if we contrast that to a regular loan, if I stop paying the mortgage on my house, or I stop paying my taxes, or my HOA if I had one, the bank would foreclose, correct?
Good point, Brett. On a reverse mortgage, certainly you don't have that risk of being foreclosed because you don't make monthly mortgage payments. And so if something goes wrong in your life, there's not that risk. However, if you don't pay your taxes or insurance, you can be foreclosed on just like somebody without a mortgage. If you don't pay your taxes, eventually the county's going to come after you. So you're still required to pay taxes, insurance, homeowner fees, normal maintenance. You still get to mow the lawn, shovel the snow.
So I can't keep that house though and then move into a retirement community, correct? I can't have...
That's correct. The reverse mortgage is a owner-occupied loan, so you do have to be in the house. You can't move out and rent it. But you might sell it. You're allowed to sell the reverse mortgage, or sell the home and pay off the reverse mortgage, because you're still the owner. So that probably brings up the second concern, is the equity left when you do sell. Most people, by the time they do the reverse mortgage, have pretty much decided they're going to stay in the home for the rest of their life. So they're not too concerned what the equity might be. Their heirs will get it, whatever it is. And most of the time, there is equity in the home. Generally, home values are going up like this, and the loan amount might be going up like this. And so over time, there's usually, in fact, when I do the amortization schedules, in most cases, there's more equity at the age 99, which as far as we go with the amortization schedule, than there was to begin with. But we saw in 2008, that doesn't always happen, home values drop like that. So the people who had a reverse mortgage during that time, the drop in housing prices was a non-issue. They still had access to their line of credit. If they were taking monthly payments, they still had access to the monthly payments. They didn't have to be concerned what the house was worth because they were still living in it, and they still had access to the way it was designed to work for them. But it's possible that when the loan comes due, the house is worth less than what you owe. So worst case scenario in that case is that you or your heirs hand the keys over to the lender and do let the lender take the house in that example. The heirs don't want to be bothered having to go through the selling process. That's a pain. Why do that if they're not going to get any money out of it? So there is a backup plan, because then the MIP, the mortgage insurance, pays the shortage. So that the lender is willing to do that because they know if they have to take the house back, they're going to sell it for the best price they can get. And if that's less than what the borrower owes, they'll apply to FHA to be reimbursed for that shortage.
Great, thank you, Tom. So a couple of things. I could use that money to have Ryan come in and provide in-home care if I needed it, as I'm aging in place, correct?
Yes, and that's kind of where I'm aiming on building up my line of credit so that when I'm in my 120s, I know that sounds a little silly, but generally financial planners aim for age 95, but what happens if you live longer? You know, I'm kind of counting on my good genes. My mom's side of the family, her parents, her brothers and sisters, 7 or 8 of them, all lived into their 90s. Her parents were born in the 1800s. Medicine isn't growing linearly, it's growing like this. It's already saved my life a couple times. So I'm planning on my genes offsetting my bad habits. But we need to plan for that longevity because we just don't know it. Brian said, we just don't know what it's going to be, and there are predictions that many more of us are going to be living into their hundreds than previously.
Thank you, John. I might come back to you. So Ryan, let's talk a little bit about people self-insuring, long-term care insurance. I think the statistic you gave me was about 14% of people self-insure and have long-term care insurance.
Yeah, so 14 to 16% of America has a long-term care insurance policy.
So when I asked about Genworth, a lot of hands went up. People knew what Genworth was. Can I just get a rough idea here? How many people have a long-term care insurance, if you're willing to share? That's probably more than 14%, isn't it, by the look of the hands? So
Yeah.
pretty good. Yeah, so congratulations to those who have it. So how does that help us in terms of care needs as we go forward? And how does it apply to our living? Does it help us pay where we live now in our home? And how does it apply to independent living, assisted living, and memory care? I know that's a lot of questions, but it's okay.
Yeah, it's okay. So every single long-term care insurance policy is different, okay? Most of the time, it will pay for assisted living, memory care, skilled nursing, and then in-home care like we provide. So those are the 4 big ones that most of them pay for, okay? You have to show that you need assistance with 2 out of the 6 activities of daily living. So I see policies, you know, we're looking at policies between 20 and 50 years that were bought 20 and 50 years ago. So a lot of these policies are, you know, unlimited lifetime maximums. So there's no, the bucket of money at the end of the rainbow never runs out. And it all depends on what your daily maximums are. So if you have, or monthly maximums, let's say. So if you have a policy that will pay for $8,000 a month, then that will pay for pretty much the nicest assisted living community in town. It'll pay for a lot of care from an in-home care agency, and it will even pay, in most cases, it'll pay for family caregivers. So if you have a family member taking care of you, sometimes you can get paid back for a family caregiver. So those are the 4 majors that it pays for: in-home care, assisted living, memory care, and skilled nursing, especially in like a long-term skilled nursing type of environment. It will not pay for independent living. It will not help with any of your expenses at your current house. It has to be some sort of assisted living.
Right, thank you. Clear. And then, so premiums are going up, as we mentioned, for long-term care policies. Tell us about that, people who are receiving letters in the mail saying, do you want to pay us more, or do you want to let go of some of your coverage? What advice would you give to those people receiving those letters? I'm sure they're going to keep receiving those letters.
Yeah. I've talked to many of my clients that have said, hey, we're getting these premium increases, sometimes to the tune of like 55%. which is absolutely gouging in my opinion. But so the biggest and most important thing I say to folks is talk to somebody who knows what they're doing, okay? Don't try to navigate it on your own. We do it for free. We'll come out and we'll assess your policy. We'll come out and this is not a sales pitch whatsoever, but we're very good at it. I mean, 35% of my clients are on long-term care insurance, if that means anything. We take care of 75 families in town, so that's a pretty big number. We've looked at hundreds, if not thousands of policies. Talk to somebody that knows what they're doing. Chances are that the insurance agent that you bought the insurance policy from is no longer around, and it probably went into a pool of what are called orphan policies, where it's just this pool of policies that have no agent assigned. Oftentimes the agent has no idea how to service the policy. And it's really sad to say, but I see it every single day. They're like, I'm trying to get a hold of my agent, but he doesn't know what he's doing. Talk to somebody that knows what they're doing. It can be like a CFA, a certified financial advisor. Some CPAs have a little bit of knowledge in that stuff, but really talk to somebody that knows what they're doing. And do not take less. I always tell people, do not take less benefits if you can afford the premium increases. Because what I see happen sometimes is they'll take, they'll get their monthly maximums cut in half, and then all of a sudden they're way outliving their insurance policy. So make sure you're very well educated on what exactly that means. If you can afford to pay the increase in insurance premiums, then absolutely do not change a thing. Unless you talk to somebody and they say, okay, you have a outstanding policy, you're 89 years old, and you're probably not going to need $2 million in lifetime coverage. The average cost of nursing or of assisted living, that could be skilled nursing or anything like that, is approaching $70,000 a year these days. So if that tells you, that's a pretty big number. So just make sure you talk to somebody who knows what they're doing, and don't accept less unless you're advised to do so.
And then on that, if I need to cut down, I don't have the funds to pay this exorbitant 55% increase, are you able to help advise in terms of which particular benefits would make the most sense if we have to let go of something, what that would be?
Yeah, in the last couple of years we've seen it a lot. That's when, especially Genworth there, and I've talked to multiple people in this room alone. People want to drop their policies altogether. It's use it or lose it. Long-term care insurance is use it or lose it. So if there's no cash value at the end of the tunnel, okay? So make sure you talk to somebody that knows what they're doing. If I look at a policy and I say, hey, that same 85-year-old or 90-year-old, and they have an outstanding policy that they bought 30 years ago, I'll tell them, yeah, you know what, you can absolutely cut it by certain things, but there's so many different caveats with that. It can be, monthly premiums or monthly maximums that get cut down. It can be, no more inflation rider, something like that, because that's inflation riders. I don't want to get too far into the weeds, but it could be a lot of different things, and every insurance policy is vastly different. So just make sure that you are educated and that you make an educated decision.
Thank you. Let's talk about veterans aid and attendance for our veterans. Tom, you want something?
If I can hop in real quick.
You got 30 seconds.
Okay, that's all I need. For those who have an existing long-term care policy, the reverse mortgage line of credit can be a backup for those things it doesn't cover. And if you chose not to get a long-term care policy or you couldn't qualify, again, the reverse mortgage line of credit may be a salvation.
Interesting. So I could use my reverse mortgage to pay for my additional premium, so 55%, because I spoke to Ryan and told him.
That's one way to do it, certainly.
And could I buy a policy now? What's the age limit for?
It's all on agent health. So they come out and they do an assessment on you. Most of the time, I would say past 65, you're going to be paying through the nose for premiums if you try to get a long-term care policy at that point. I think the wheelhouse is roughly 50 to 60 is when people are buying most of the time. I will say this that I forgot to mention. Once you go on claim with a long-term care insurance policy, you typically have a waiver of premium. So you stop paying your premiums as long as you're on claim. It's very important to mention. So if you're at the cusp of needing help with 2 out of the 6 activities of daily living, you have an unlimited lifetime policy that'll pay for $8,000 a month, which is a lot. I tell people, why don't we put you on claim? because you're not drawing away from the bucket of money at the end of the rainbow at that point. So that's one thing we strongly advise on too sometimes, is if they're getting right there where they could really use the help, and they can't afford the premiums anymore, or it's getting tight for like a limited budget or a fixed budget, in other words, then we'll tell them, hey, why don't we just put you on claim? So going back to your other question, sorry, about veterans aid and attendance. So most people.
Before we do jump onto that,
Sure.
just a question on that. So, lost my train of thought for a moment.
Talking about waiver of premium. It's because you're not wearing a tie.
Yeah. Something Tom said. Well, I guess a good thing for the audience, if we're past 65, okay, it's probably going to be prohibitive, but it's probably a good thing for adult children to at least consider if they haven't thought about it.
For sure. And there's also long-term care insurance policies that are called hybrids, where it's a life long-term care. So if you pass away before you're ever put on a claim for long-term care insurance, then there's a life benefit that can go to your family. So talk to your financial advisor about those if you're past 65. And again, it's all age and health dependent. So if you're 75 and you're healthy as an ox, then maybe it's worth looking at.
Right, thank you. And maybe I'll have you touch on that, Brian, when I talk to you next. I remembered what I was going to ask you. Is why do people hold off starting to make use of their long-term care insurance? You were mentioning to me that people wait too long, so please
All the time.
not to wait.
Yeah, nobody ever said I wish I would have waited, right? So most people, it's pride. They don't want someone in their home. They don't want to kind of admit that they need to move to assisted living. If there's dementia involved, then a lot of times they're very proud, and I get it. I mean, I wouldn't want someone in my home daily. But it's mostly that, and people just think that for whatever reason, people think they're gonna start their policy and that the money's just gonna go away. Well, have somebody look at it first, because it could be unlimited lifetime. And then again, you're never drawing away from that bucket of money. So most of the time it's pride. A lot of times it's, the spouse doesn't want a caregiver in their home. The spouse doesn't want to move to assisted living. Or the spouse is like, I want to keep, my husband at home, but he's got severe dementia. And it's like, she's frazzled and can't take care of the spouse anymore. And she's just totally frying herself out. The number one burnout in caregiving, and for all the caregivers, are family caregivers. So just know, don't wait. If you think you might need help, call someone that knows what they're doing. And even if we never take you on as a client, at least we'll come out and tell you what we can do and tell you how much it'll cost, and if long-term care insurance policy will cover it, or other. We look at all kinds of different options like life insurance, cash outs, and stuff like that.
Great, thank you. So let's talk about our veterans and how veterans and aid and attendance may be able to help, and again, what types of housing situations and care.
Okay.
Who qualifies?
Yeah. Show of hands, who is a veteran in here? Thank you so very much for your service. Okay, so veterans aid and attendance, and I don't want to get too far into the weeds, and I know Brett's looking at me like I'm on the time clock, so veterans aid and attendance is a very little known stipend policy through the VA. So the qualifications are pretty simple. You have to have served during one day during that time of war. You don't have to be shooting artillery off of the front of an aircraft carrier. You don't have to be, shooting guns in Vietnam or anything like that. You could be basket weaving in Nebraska. But as long as you serve that one day during a time of war, that's the first qualification. The second qualification is assets. And Vic, I think, what's the bright line these days? I think it's 118?
130.
130, okay, so that's gone up a little bit. So if you have 130 or less in liquid assets, and that does not include the home you live in, then chances are you qualify. There's a couple other things, and again, I don't want to get too far into the weeds, but veterans or spouses of veterans, not spouses, a widow of a veteran. So a widow of a veteran can receive up to $1,200 in reimbursement, and it is strictly reimbursement. We don't do the policy at all. It's you pay for the care, and then you get reimbursed from the VA. So widows, $1,200. A veteran, like you gentlemen that raised your hands, up to $1,800. And then if you're a married couple that both served during the time of war, $2,800, and that's strictly in reimbursement. So that's always worth looking at. The first two questions we ask: do you have a long-term care insurance policy? Or are you a veteran? And if one of those two match, then we're looking at all the different options for care. So that's just the very, very basic, like high-level overview of the VA aid and attendance, and we can talk more offline when we wrap up here.
Great, thank you, Ryan. And what other resources are available? If we think we might qualify or someone we know, who do they reach out to for help? Do we call the VA or where do we go?
No, we refer someone, Schultz Law Group, Melissa Hartman, actually they handle all of our claims for VA. They're excellent, they get stuff pushed through very, very quickly. There's veterans resource, VROs, veterans resource organizations out there that can help. I personally have not had very good luck with them. They charge to actually do that, which to me is just not right, but they'll charge you to push the claim through. When, the biggest thing with VA aid and attendance is do not try to do it yourself. Do not try to do it yourself. You're gonna go into just a sea of red tape. And sometimes we took care of a guy for 2 years before he finally got his claim approved. And at the end, we finally got the reimbursement check, and I'm like, man, we've been floating this guy for a long time. But he tried to do it himself. So talk to someone that knows what they're doing with the VA as well.
So it sounds expensive to go to a law group, Schultz Law Group, to have them do it for you, so what does that cost?
It's free.
Say it again?
It's free. Yeah, they do it completely pro bono.
Do widows qualify?
So widows can get up to $1,200 a month in reimbursement. If that widow needs help with 2 out of the 6 activities of daily living. So it's the same as long-term care, 2 out of 6. You need to show that you have care for 2 out of the 6. And a lot of times family caregivers can get paid for that too. It kind of depends. It's a little wonky, but we as an agency, we get the reimbursement pushed through, and it's no big deal because we send out our care notes and all that stuff.
Just for those who aren't aware, Schultz Law Group is one of our education partners here. Rich and Melissa couldn't be here today. Normally Melissa's greeting everyone at the door. But in your booklet has their details, so if you know someone who needs assistance, the business card is in your binder. So thank you, Ryan. So let's come to you, Brian. I'd like to talk about some of the misconceptions about Medicare and Medicaid. Let's start with Medicare. Just in general terms, how does that help us pay for long-term living in terms of our housing situation?
Long answer, it doesn't.
Next question.
Medicare, I'm almost 65. I'm blessed with this useful exterior, but and I'll be eligible to apply for Medicare in October. However, like Medicare is supposed to help you with your medical costs and hospitalization. Experts say that a medical cost for a couple age 65 and older is going to spend somewhere between $350,000 to $420,000, $500,000 in medical costs, excluding long-term care. But long-term care needs are not covered by Medicare.
I saw people shaking their heads. So how $300,000 or $400,000 over from 65 to where's all that money go? Any idea?
Part of it's for insurance premiums. Part of it's how much. I'm on a board of a hospital. I mean, what's the daily cost of occupation? God forbid I get hit in the head with a hammer. Expensive, right? And so those are your costs.
And then usually, if I understand correctly, the last years of our life when it really becomes expensive.
Yeah, unfortunately, yes.
So let's talk about Medicaid then. Is that a planning tool you use with clients in order to help with housing and so forth and care? Explain what Medicaid's purpose is.
Okay, like veterans coverage that Ryan was just talking about, it's a government-sponsored plan. I think 1 out of 5 Americans is on Medicaid. I didn't realize how many people are on Medicaid. And it's to cover a wide range of expenses, but it's primarily to help people with lower income. But that does provide some help with your long-term care.
So is that a planning tool that we should be planning, okay, I'm covered, I'll have Medicaid, or is that more of a fallback? Do you use it as part of your financial planning with clients out of interest?
Well, there's 2 ways to do financial planning. One is to have a ton of wealth to pass on to your kids and loved ones. The other one is to have the last check you write bounce. Right? Medicaid might be for that lower income need. So are you trying to, it's a fallback position. I don't think any of us might plan for that, but it's there. So you can maintain, live life with dignity. It's an important plan.
Okay. Anything else we should know on either of those, Medicare or Medicaid?
Medicaid does have a waiver program that will pay for in-home care. It's not much. I've never taken Medicaid personally, but there are companies that do take Medicaid. It's very low hours. It's like 2 hours twice a week or something like that you get care. But there is a waiver program through Medicaid.
So will it help me in independent living?
No,
No. Assisted living?
possibly,
Memory care?
possibly. Yeah.
Long-term nursing care?
That would be probably more long-term nursing care and then in-home care in some cases. Yeah.
Thank you.
I'm sorry, nursing care, yes. There are a lot of nursing homes that take Medicaid.
And do we have those in our area?
Yes. I don't know exactly which ones anymore because they're always all around the map. But.
Great. What are you on time? So Brian, let's go full circle. So we've covered how many? 1, 2, 3, 4, 5, 6. Has anyone had a look in their handout as to how many different ways we have of funding retirement? How many does it say on the handout on the second page? I saw people reading ahead at the beginning, taking notes. I think we have 8, is that right? 8.
Yes.
So what are the 2 we missed?
Family.
Family.
Faith.
So I heard some people down in the front row when we got started, their plan is their adult children are going to be, that is their long-term living plan. Yeah. So family is one, and in all seriousness, yeah, maybe it's moving in with a family member. Maybe it's moving in with a sibling as we age. Maybe a sibling's lost their spouse and we can come together and share costs and so forth. Maybe it's moving in with adult children. Our typical advice in past seminars, if your plan is to move in with your adult children, you should probably do what in advance? Let them know, tell them. Otherwise, when you arrive, they may have changed the lock. Sorry about that. It's your plan, but not our plan. And then, what was the 8th one? What was the other one we missed? Faith-based, yeah. So do we have any faith-based organisations here that help in terms of any of those forms of care or living? No. So no. So some people that we've spoken with, I'm not aware of any, but there are some communities, like retirement communities in other parts of the country that are faith-based that will help subsidise the care and the living. We don't have them here, but again, that might be something potentially to explore, at least be aware of. So, Brian, coming full circle back, a couple of questions for you. Number one, is there anything we need to be aware of as a we, that if we were to lose our spouse, and unfortunately that's something we all have to deal with at some point, that we can set them up in a much better position by doing certain things now from a financial planning perspective?
Yes, absolutely. I love this chart, by the way. Look at this. It's a bubble chart. Things are going to change, right? But even think about this planning thing. How many of you can, with 100% certainty, know that your spouse knows what your financial plan is? Okay. Second question, spouses, significant others. How many of you know what the other person's got in mind? Not necessarily. So, yes? You're living single. Okay, way to go. That's a joke. But it's good. So there's, living through transitions. Transition planning is probably one of the most important things and basis for financial planning. Because like these circles, they're all going to change. Transitions include, might be retirement, having aging, having your kids move back in with you, giving away your wealth to your kids, like prematurely gifting them money because they can't afford to buy homes today, and finding yourself, if you're in a couple, finding yourself suddenly alone. So we talk about the 3 A's. One of them is called alignment. Make sure that your priorities and your plans are in sync. What you want to do, your partner agrees with. Number 2 is awareness. Know where things are and know how things work. Where things are can be as simple as where the passwords are. If you list of all your bill pay accounts, how many people have got those written down that everyone knows about? I forgot where I put mine sometimes, right? But know where that is. Your investment accounts, where are all your sources of income? Where are your Social Security and pension checks going for your bank? What if you change banks? Know how these things all work together. And then allies. You talked about some of these things already. It's usually family, life's a lot better when you're not walking life alone, life paths alone. So it's about having advisors, professional, personal, they could be social, they could be spiritual, and definitely family. But it's planning ahead, because things do change.
And do you find that often that when a significant other or spouse passes, the surviving spouse doesn't know where a lot of those things are, doesn't know where the sources of money are coming from, or which institutions the money is at? Is that common?
It's, we find it's common. I mean, about 2/3 of our clients are retired. And as much as you try to communicate, I mean, it is a surprise. It's the loss of a loved one is one of the biggest shocks we all have. And we're all told not to make any big decisions, usually for 6 months. But it's legal. You talk about the Schultz Group. I mean, what's your roles as executor or trustee? How do you make things work? Where are things at? How does it change my benefits? I might have a pension benefit from the state of Nevada, but am I going to get anything left over? And maybe I'm getting 100% of benefits, maybe I'm getting 50%, maybe I'm getting 0. And then, of course, investment, where are my accounts at?
So I'm hearing a lot of people aren't aware of the impact to their pension or social security. As a we, this is what's coming in, but when it's a me, maybe things change. It's not the same amount of money coming into the home. Would that be correct?
Yes, sir. I mean, it was like, I think you started off saying like that people spend more time planning their vacation than working on their finances, because one's a lot funner to talk about. How fun is it to talk about the loss of my mental capacities or the loss of my loved one? Sometimes you need a third party to help you walk through that.
Thank you. So let's talk about money that we have. How can we get better returns on it now? We have higher inflation, and I think you were going to touch on Social Security as well. We all got a pay rise last year for Social Security. We're going to get another pay rise for next year. Just the impact of inflation on that. And then secondly, where can we put money now to get a better return?
I think Tom was talking about CDs paying 6%, right?
Well, that was a long time.
Okay, but wasn't that great? But so was the cost of borrowing money. So was the cost of living. Social Security, I think last year paid us an increase of a little over 5.5%, right? We got a pay bump, yay. Where did it all go?
Inflation.
Thank you. Medicare went up, like almost 15%. So inflation is like this, we call it a hidden menace, because it bites at your purchasing power. It erodes your ability to spend. If inflation just averaged 3%, we got to double our money every 24 years just to buy the same basket of groceries. So that's an important part. How can we get higher returns? How many guys, bank returns, they're not paying 6%, but they're paying way less than that, right?
0.004.
Thank you. That's like gnats bottom to the ground, right? Why not look at online money market accounts? Go to bankrate.com and look at
What was that website?
bankrate.com. And it's a source of all kinds of rates. It's savings rates, borrowing rates, etc. I don't know if there's reverse mortgage rates on there. But anyway, you can get these money market accounts that are FDIC insured that pay 1 to 2% right now. $100,000 could pay you $2,000, free money. What would you do with $2,000 a year? Okay. Yeah. Series I bonds, government bonds. You know how much those things are paying?
9.4.
Thank you. Yeah, a little over 9.5%. They're paying that rate at least through October. You can't put a bunch of money in there, but it's just a little piece. Go and rebalance your investment portfolio. I mean, you can't afford to have all your money stuffed in a mattress that's going to be there, but it's going to earn 0. Work with your financial advisor on that. You're talking about real estate. Are you increasing your rents to keep pace? I mean, your costs are going up. But on the other hand, maybe you want to keep rents the way they are because you're happy with who your tenants are. Trade out.
We should rent our son's room now. Get rid of him and rent his room out. So talk more about these I-series bonds. Where are the I-series bonds? Just show of hands. So only a small percentage of the audience. So just explain those. It's phenomenal. What is it? Where from? How do you do it?
Yeah.
What are the limits?
Go to the government. TreasuryDirect.com is .gov. Thank you. Is the website. And you can invest, remember good old Series E bonds? You pay $25 and in 20 years they double to, to $50 or whatever it is. These things will pay interest twice a year. You can invest, I believe, up to $10,000 a year individually, so couples can partner up. And then you have to have your money invested, I think, for at least a year.
Repeat the website, please.
TreasuryDirect, one word, .gov. Just another place to put your money.
9% return's pretty darn good. And if you have a trust, that's another 10,000. So husband and wife 10 each, and if you have a trust, your trust can put in 10. And it's the government, so if the government goes broke, I guess we've all got bigger problems to worry about. Numbers print more money, so. Yeah.
People use these for educational funding. You put it like, put your grandchild, a niece or nephew as a joint owner on this. It's just to get them started with investments. There may be some tax benefits on there if it's used for education purposes.
Right, thank you, Brian. Anything else you'd like to add before we open up question and answers? You good, Tom?
I'll toss in just real quick. I inherited a whole bunch of Life magazines, and in one of them from the 1960s was an ad from an insurance company. And it shows this couple on a Hawaiian beach. And it says, "We invested with our insurance agent, and now we're going to get $250 a month when we retire." That gives you an idea of the impact of inflation just from the 60s.
Brian, do you have anything you want to add?
Well, that's, Hawaii's only costs $25 a day. If you're cheap Chinese, so.
Our bags were buffet. That was a good tip you can take away. Take your plastic bag and get the buffet. Next slide, Ed, if you could help me with that. So next month we have our, next month, September the 15th, our next seminar back here is The Truth About Advocating for Yourself and Those You Love. So if you would like to attend, you all have a yellow evaluation form and there's a checkbox on there. You can pre-register and we'll get you registered for next month. Following on today, for those who want to know a little bit more about reverse mortgage, Debbie Wood with Flagstaff Bank is actually going to do a workshop next Thursday at 10:30 a.m. We don't have the time, but you should all have a flyer on it. And Debbie, are you about? Can you just run up here and just tell us a little bit about what you're going to talk about at the workshop next Thursday? So it's not here. It's in our office, in our training room, and the directions are on the flyer. So if you wish to attend, after you hear what Debbie's going to talk about, again on the yellow evaluation form, just check the box. And keep the piece of paper with the directions. If you've never been to our office before and you rely on Google, you are going to get lost and frustrated. But if you, yes, people can attest to it, you want to use the directions we're given on the piece of paper and you will get there successfully. So Debbie, tell us a little bit about what you're going to cover next Thursday.
I've been to that office a couple of times.
Can you hold your mic up a bit closer, Debbie?
Trusting, read his directions.
A little closer, Debbie, with the mic.
Okay, so I'm Debbie Wood, and I'm with Flagstaff Bank. I am a loan officer there, and I have been in this business for 35 years. I added reverse mortgages to my realm of offerings about 25 years ago. But this workshop that I'm going to do is not so much about reverse mortgages. It's a comparison. I want to explain to you why a regular mortgage may or may not be better for you than a reverse mortgage. I want to compare, I know Tom was talking about lines of credit and a reverse mortgage. What if you just got a regular line of credit through your bank against your mortgage? Compare that to reverse mortgages. So it's not every type of loan is good for every type of person, so everybody has differences. I also want to maybe just talk about getting a cash out refinance if you need to access some of your equity. And how does that compare to a regular home equity line of credit? And then the seminars too about, I want you to ask me questions, things that maybe you've always wanted to know, but really didn't even know how, or maybe were afraid to ask, right? So I want you to ask me questions, things like, well, why do you have to have an appraisal done when you refinance your house? Why are condominiums harder to finance? Why are manufactured homes treated differently than stick-built homes? What if you got an inheritance? Should you pay off your mortgage with that or do something else with it? Why did interest rates go up and why so fast? And what's going to happen in the future? Have you heard these commercials about title locks? What are those? And what is that about? Is that a scam? So those are the kinds of things we're going to talk about. It's not just about one subject. It's about everything to do with your real estate financing and what's the best way to do it for you and what works best for you. This is also good, so if you have kids or grandkids that are starting to think about getting into the home ownership business, you might want to invite them too. So it can be very basic or we can get very detailed. But that's what I intend to do, is have you ask me questions that you want to know. And then if you don't have any, we'll cover some of these basics that I just talked about.
Great, thank you so much, Debbie. So that's next Thursday, what date? August the 25th. Again, out of our office, follow the directions, 10:30 a.m. And it'll be about an hour, Debbie, is that right? Hour, 90 minutes tops?
90 minutes tops, because I have a wedding to plan 2 days later.
And it's free. And Debbie's not going to sell you anything. There's no steak knives or anything to go with it. So then on September the 22nd, we have a wait list now, I believe, our community bus tour. So for those who weren't here last month and didn't sign up and might be interested, we're going to arrange 4 buses. We're going to meet out the front here. Not sure at what time, but on Thursday, September the 22nd, we're going to split everybody into 4 groups. We're going to board a bus, and then we're going to go to 4 communities. We're going to go to Mountain Lakes Estates, an independent living community. We're going to go to Revel Ranchera, independent living community. We're going to go to Clearwater Ranchera, an assisted living memory care community. And we're going to go to 5 Star, which is an independent living, assisted living community. They're going to provide us with lunch, wine and beer. I know one of them will. And yeah, you'll get to see and experience as a group. I think we can fit about 12 people per bus. And just see what modern communities look like and ask questions in a group setting and get the feel. Just for future planning. You know, maybe no plans at all now, but maybe in 10 years, 15 years, maybe someone you know that might be a fit. It's just to learn more in a good, safe environment. So if you haven't already signed up for that, check the box and we'll reach out to you probably in about the next week, Alexa, with confirmations within the next 2 weeks and confirm your spot. So put it on your calendar if you check the box. Yeah, we'll follow up and confirm that you are definitely participating. And then October the 15th, the truth about a CPA and an attorney who walked into a bar. We seem to have been talking a lot about alcohol today, beer and wine, bar. But anyway, that will be fun with Rich Schultz and a couple of other panelists. And then November, a date change. We're unable to use this venue on the 17th. We were, but RSAR, the Reno Spark Association of Realtors, is such a great partner with this room for us. They have a conflict and ask, is there any way we can move our next seminar to the 10th? And we want to help them because they're always helping us. So November will be on the 10th, not the 17th. So if you've already had the seminars on your calendar, November will be on Thursday the 10th instead of the 17th. Okay? So if you come on the 17th, none of us will be here. You'll be sitting in on some other class on real estate. I think that's all the housekeeping. Did I miss anything, Alexa? Yes, I did miss one thing, didn't I? For the last 3 months, Alexa keeps handing me this and I keep forgetting about it. So we would love you to help us grow the audience. So we have tear sheets that we can put up in local supermarkets, coffee shops and so forth, where people can kind of like tear one of these off, has the website, the phone number to register for the seminars. So if you're willing to help us and you have places you frequent, whether it's a coffee shop, your gym, whatever it might be, and they have a bulletin board, we'd really love you to see Alexa at the end and take 1 or 2 or 10 of these and put them up around town. That would really help us to spread the word. So if you're able to do that, yeah, see Alexa and she'll give you some of those. So next slide, and then I think we'll have a little housekeeping. So yeah, let's start with questions. I have 2 mic runners. If they can come up the front and join me. Jeff and Vic, and I see hands waving already. So I recognise the hands. Jeff, could you just introduce who you are and who you're with as one of our education partners?
Hey, good morning. I'm Jeff Van Diepen. Our company is Safety Squads. We have a little booth out here. You're welcome to come by and get some information. We're essentially a handyman service specifically designed to assist seniors to stay in their homes. So if you have questions or would like to learn more about it, please stop by. I'll be here after the meeting.
Great, thanks Jeff. Jeff's going to take the left-hand side of the room looking out from the stage. And with him we have Vic.
Testing. Oh, it's on.
Your name's testing today.
Good morning, everybody. My name is Vic Denegris. I'm with Amada Senior Care, Ryan Hart's company here. I'm his Director of Community Relations. I've been with the company about 4 years. And I'm the guy who Ryan kind of relinquished some of his beloved professional duties to a few years ago. I do a lot of the outreach in the community for the company, as well as I do the in-home consultations with clients and family to talk about home care services or what other options might be out there for them. Best course of action for care for that individual. I also do the long-term care insurance assessments for clients as well. So if you have any questions on that stuff, feel free to come up to me anytime and ask. I am here every month as well. So nice talking to you all.
Thank you, Vic. And I know Vic is super knowledgeable.
Brett,
Yes.
Thank you.
before you move on, there has been, and let me go back. This is actually October, it's October 13th. This is not correct. So what's in your calendar, don't change the date for October. It is
I can't type when I put slides together, obviously.
It stays, what is on your calendar for October, it is October 13th, not the 15th that's written up here.
Did anyone else catch that other than Annette?
Oh no, I have members tell me
Oh, yeah.
or ask me, so I just want to make sure we're all on the same page. What is on your calendar is correct, not what is up here for the October.
So it's October 13th and then November 10th.
November 10th, yes. Yeah.
I should have someone proofread the slide. So, hand down the back bit, we can start there. And then on this side of the room, who has a question? And Jeff will come over to you.
My question is regarding the assets that you have to downsize to on Medicare. What is the current amount of assets that you are allowed to keep in order to qualify for Medicare? Medicaid, sorry. Medicaid.
Sorry, I don't think we know.
Why not?
I can toss in the house doesn't count.
Yeah, we've never taken Medicaid, so I can't answer that. Does any of our education partners, I think, like Providence, they might be able to help?
Yeah, because at one time it was like $2,000, but that was a long time ago.
It's a low amount.
I know that ongoing, $2,000 is the most you can have in your liquid account.
Still,
Ongoing.
Yes, that
wow.
That part I know. So maybe that answers your question. That's what you have to get down to. And there are certain things that aren't counted. I'll mention that when somebody has a reverse mortgage and they're applying for Medicaid, that's certainly allowed, but they have to be careful how they list their assets and liabilities on the sheet, because the reverse mortgage is a liability, not an asset. It's the house that's the asset. So they can have a line of credit and not be penalized.
Thank you, Tom. Another question over this gentleman next, Jeff, and on the left-hand side, Jeff.
I hear the 300K to 450 for medical care after 65 quite a lot. What part of this is covered by Medicare?
Great question. Do you know at all how that's broken down, Brian? In terms of that 300 to 450 between 65 and end of life that we're going to spend on medical?
It was just an overall estimate of what your out-of-pocket costs are going to be. Overall. And that's, that's after, that's your out-of-pocket costs, your co-insurance, and your premiums. So that's after what Medicare is going to pay. The point of that was, two of them. Number one is, and it was about that slide, you talked about three-legged stool, like people have income coming in from 3 different sources: pensions, Social Security, and investments. Well, those things are going to change, and usually your investments are going to decline. You need to leave some more gas in the tank so you don't end up with just $2,000 or whatever you qualify for Medicaid. That's point number one, is just make sure you have enough. Second of all, because it doesn't pay enough, and I don't sell insurance either, people get supplemental plans for insurance. So they pick up what Medicare does not cover.
The other thing that might help, Joe, just in the handout, according to Genworth, Northern Nevada private nursing home fees are close to the national average of $307 a day, which is $110,000 annually. So if you ended up in nursing care for 3 years at 110 grand a year, there's $330,000 just there.
And that's on top of that 350 to 420. That was just purely medical costs.
Just medical, is it? Okay.
Growing old isn't for wussies, right?
Where are we, Vic? Yes, thank you.
This is for Brian Loy again. What was that, one more time, what was that Treasury?
The website,
Yeah.
sir? treasurydirect.gov.
Where are we, Jeff? Gentleman down front?
This question is to Ryan. I was in the United States Army Reserve during the Vietnam era. At the time when I was in the reserves, we were told VA benefits were an American flag and a gravestone. That's all we were entitled to. I know that this has changed because I have a VA loan on a house. So they changed the thing. Could you explain again when you were talking about the VA benefit of the $1,200 and what were the two things you have, the two boxes that need to be ticked?
Okay, so to answer your question on reservists, did you ever serve active duty?
Yeah,
Okay, and was that ever during a time of war?
absolutely.
Okay, then that's good there. So you're good to go there. Okay. Now, as far as the 2 check boxes, so you need to have 2 of the 6 activities of daily living. So let's say you need help getting from a sitting to a standing position, which is a transfer. Let's say you need help feeding, which you may or may not need, bathing, toileting. Those are 4 of the 6. If you qualify, you just need help with 2 of them, and then that would potentially qualify you for the aid and attendance. Does that answer your question?
It does, thank you very much.
You're welcome.
I have one more quick thing to add for the veterans out there. There's another nonprofit organization here in town. This organization is called the State of Nevada Department of Veterans Services. This is not the VA. These folks do not work for the VA, but they are excellent about helping you get knowledge about what benefits you might have coming your way. Their number, if you want to write this down too, guys, this is a great organization. They're at 775-825-9849. Again, that's the State of Nevada Department of Veterans Services, and they are nonprofit.
Thank you, Vic. One more question. Question? Yeah.
Yes, I'd like to thank all 3 of you. You gave us a lot of good information. My question is for you, Ryan. You had mentioned a lot of people between the ages 55 to 60 have bought long-term health care. What is your advice for those of us that have waited?
So it's every situation is so different. My advice is probably if you're over 65 but still pretty healthy, I think that you would probably want to talk to your financial advisor about one of those hybrid policies, which is a life long-term care hybrid. I think that's probably the best. And there's no guarantees that you qualify for it, but they're less expensive. And in my opinion, they're not selling the same policies that they were back in 20, 30 years ago. They're non-existent anymore because they've found that people are people are just living longer. And that's why they're jacking all the premiums up. It's because people are living longer and they're having to pay out all these claims and they didn't prepare for this, right? If you have waited, I would talk to your financial person and ask them about a life long-term care hybrid. I think that's probably the best route to go.
Thank you.
I would also add, as a financial advisor, I remember seeing on your bubble chart, self-pay or self-insure. I mean, do you even need insurance? If you're, can you afford to take that $91,000 a year expense on your own? You're not going to live forever in assisted living. Usually, I've seen forecasts that if you go into assisted living, it's about 4 years of expense. So we might build in a $400,000 expense on a financial stress test and say, can you afford to take that? Second point is, regardless, I've heard, whatever age you buy long-term care insurance, whether you're younger or older, you're going to pay the same amount of premium over the life of your life term. So at 65, if I go buy insurance, I'm going to pay a heck of a lot than if I had done it earlier. And then the third thing, Tom was saying he's going to live to 120. If we ran your forecast to age 97, maybe 98, you should take up bungee jumping.
Question over here.
Yeah, excuse me, I have two questions. What does put you on claim mean exactly?
Put you on claim just basically means we start a claim for you. So we vetted out the policy, we know exactly what it will and will not pay for. And so if you qualify for either 2 of the 6 activities of daily living that you need assistance with, and those are honestly very easy to do, then we will start a claim for you. And we do that whole process for you. Or if you have dementia or any sort of dementia-related things, that also qualifies you separately from the 2 of the 6 activities of daily living. So it just basically means we start a claim for you.
Okay, so we don't have to actually move into an assisted.
No, if you're looking at that, yes, that would be fine. But it relates to in-home care too.
Okay. The second question is assisted living. We can't get into an assisted living facility because we haven't been COVID vaccinated. So what is our alternative?
Really?
Yes.
Interesting, I didn't know that was going on. So if you want to stay at home, you can always have in-home care. There are group home options. You two are spouses. So those are smaller houses, typically single-family homes, where they have one caregiver around the clock that's there, and it's someone's home that they've converted into a group home. So you'd be there with like 4 to 6 other residents. They're typically a lot smaller. The meals aren't nearly as good as these, assisted living communities or independent living communities. But really, if there's no place that won't take you without a COVID, even if you sign a declination form, they still won't take you?
No, they wouldn't even give us the tour.
Interesting, okay. Yeah, I hadn't heard that.
It's supposedly state law that in assisted living, they have to be vaccinated. However, if you go to a hospital, a real hospital, renowned, whatever, no vaccination required.
Huh.
And it's crazy.
How long ago was that you spoke to the assisted living on that? Was that recent?
Was that recently?
Yeah, it's a better one.
Okay. Yeah, I hadn't heard that, so I apologize. I don't really have a good answer for you. Private homes, like group homes, would be an option, or getting in-home care.
What is that? Is it legal? I mean, can they actually keep you out because you haven't had a COVID yet?
If it's a state mandate, then yeah.
So we don't know the answer legally, but Ryan said yeah. So the question was, is it legal not to allow you in? If it's a state mandate, then I guess so, but none of us are legal experts. So.
Well, we're all regulated by the Department of Public and Behavioral Health, and if that's their mandate, then that's their mandate, and it's probably state specific too, honestly. So, apologize, I don't have a better answer for you.
You see me underneath one of the bridges down there.
Nick, down the front. Any other questions on that side of the room? Jeff, can come to you.
Different places.
All right. Next, Dave.
Yes, on paying for retirement living, my question is, what financial arrangements are required by assisted living and memory communities to ensure that they'll continue to be paid?
Great question, David. I'm just a little nervous because you're looking at me. I'm certainly going to be looking at you. Who would like to take that?
I don't, do we have any senior communities here?
No, not today.
Today?
Okay, so the little that I can answer with that is that they would probably have, they would do a financial look back and make sure that you do have the funds available. But I mean, there's no guarantees in life, right? You know, people have to move out to go to long-term care nursing home, and you know, there's no, I think they require a 30-day notice. But I think that would kind of be on the honor system, honestly. Yeah, there's no good answer to that one that I know of.
Unless Brian has some.
Two thoughts about that. I heard in California, we got clients in California, that if you got into assisted living, that they couldn't kick you out. You didn't have enough wealth. That rule may have changed, and Tom may know more about that. However, I'll just tell you a little quick personal story. It's about my mother and father-in-law. Both of them were hit by this meteorite called Parkinson's disease. And in the matter of 3 years, we went from 4 hours a day, 4 hours a week, in-home care, to moving my father-in-law out, moving my mother-in-law out, selling their home, and we didn't know about your services at that time, what a great service you have, and then they both passed in 3 years. The concern we had was, do you have enough? It's like running out, sending a receiver out for a long pass. Is the ball, they're going to line up, are we going to have enough? And nobody has an expectation, no one knows what their life expectancy is going to be. We're dealing with uncertainty all the time. And so, whatever the care facility is probably talk to your financial team and just have them run some scenarios. What if I live 4 years, which I think most people are going to forecast, can I live that long? And then second of all, what if you live longer? I've got a client who lived in there for 10 years. For couples, often what we'll do is you're just looking for the cost of long-term care for the first person. Because that's the most expensive, because you have 2 households to maintain. The second one is, and if you haven't done a reverse mortgage, is you use the equity in your home, or you can use your equity down the road, if the second person goes in. Does that help? It's a forecast.
Exactly. And then just to expand on what you asked, because Annette and I know a little bit, having worked with many retirement communities here and also in California and elsewhere, is as Ryan said, yeah, they want to look at your financials moving in because you're signing at least 3 years, so they want to make sure you can pay that. Beyond that, for like here, it's an eviction, it's like rent. You are renting a place, you are renting a room. So if at some point down the road you're no longer able to pay, they have the right to evict you or to come up with some other financial arrangement that both parties are in agreement to. Where it is different as far as wanting to see more, so we've talked about in the past continuing care retirement communities, CCRCs, which we don't have here. They are looking at a much higher threshold because you're moving into independent living. You have to be healthy when you move in, and you're guaranteed to be able to stay there through to end of life or when you choose to leave. So assisted living, memory care, skilled nursing care. So they're looking a lot more closely, and you're paying a big buy-in amount. They're asking for $300,000 to $1 million up front that they're going to hold on to, and that's kind of their insurance. And then the third one to that, on the handout, we talked about faith-based organisations. So places in other parts of the country that are faith-based, even if you don't have the financial resources to stay there, they're more willing to help you along because they're faith-based. So just for information from other parts of the country. Jeff, someone down here with a hand up? And you can go.
I just wanted to make a quick comment. The actuary tables on independent living, assisted living, memory care facilities. My parents moved into one in Arizona, And at the time, the actuary table was 3 to 5 years, and then you'd be passed on. Well, they lived there for 17 years. I just wanted to make that comment because you, like you said with the Parkinson's, you just never know. It was wonderful, beautiful facility anyway. And they were grandfathered in. If anything happened.
I thought we attended a seminar in which there was a community living place that was continuing over in Fernley, and that you could come in as assisted living and going into nursing care, and then you could even go to the Fernley military military cemetery. And I said, Craig, that's perfect for you. Go across the street to the, and he has actually a reservation for the military cemetery. Didn't we have that, or no?
So you're correct, Ricky. So what Ricky referred to, the terminology gets confusing. So what we do have here in northern Nevada about it is a continuum of care communities. So examples of continuum of care might be the one you mentioned, but like Morningstar and Cascade, so two continuums of care they have under the same roof, independent living, assisted living, memory care. And it's a continuum of care, but again, it's a leased rent-based arrangement, so you can move from independent to assisted. But you're not guaranteed. You still need to obviously be able to pay your wage, and it's year by year or month by month. After a year, you're on month by month, or you renew for another year. But they can ask you to leave if you're not willing to meet their requirements. It's a little different to a CCRC where they're guaranteeing you're going to be healthy when you move in to independent living. It's the only way you can move in is straight to independent living. So you need to pass a physical and medical and all the rest of it. And then you're guaranteed to be able to stay there as long as you wish or when you like. A continuum of care is slightly different. Continuum of care doesn't have a buy-in. So if you look at the CCRCs, that's where you're paying $300,000 to $1 million for the right to live there, and then you're paying rent on top of that every month. A continuum of care, there's no buy-in, you're just paying month by month. Does that make sense? Yeah, hopefully that helps. Do we have another question on this side? I think we're running up on time. Any questions over here? Great, so I just want to say thank you so much for everybody coming today. I hope everyone took away at least one thing. Has anyone got an action that they're going to take as a result of today? I think I heard someone's going to look into the I-Series bonds, 9% return. So if you go to treasurydirect.gov, it's I-Series bonds you're looking for. So all sorts of bonds, but the specific one is I-Series. So thank you again. We look forward to hopefully seeing you next month. These guys will be here to take questions.